Imagine this. The sun is shining down on a cloudless day. The perfect temperature and serene walk alleviates your stress as you and your spouse drink in nature's vibes. This peaceful, long walk right after your morning coffee has become a staple of your daily routine. Business day, weekend, holiday, doesn't matter. Sounds great, right? Since going full time, my wife and I have developed a love for long walks around our neighborhood. Our son really enjoys them too. Nature just has a way of calming the nerves. However, a recent exchange between my wife and I needed to go public. You see, while trying to enjoy this early morning stroll, we found ourselves chatting through business dealings, waterline issues, evictions, local governments trying to bully, threats of lawsuits, buggy software, and on, all found their way into our conversation. This walk was supposed to be a relaxing way to clear the mind, to start the day. What happened? My wife chuckled. People desperately trying to get into this space don't realize they're just switching one job for another. But you've heard me say mobile home parks are work many, many times on this podcast. So what makes this conversation different? One word: liabilities. You see, we weren't discussing how hard we had to work. Quite the opposite. My wife and I enjoy working long hours. Rather, we were realizing that holding on to a property long term, beyond just being a limited partner, comes with some serious liabilities. And liabilities cause stress and can cost serious money, if not threaten to take your whole operation down. You want to know what no one told me starting out? What to expect when you get big. Gary Vaynerchuk says the key to staying consistent is doing something you love. If you chase money, you'll struggle to keep working and you'll eventually quit. Nearly 6 years ago, Ian and I teamed up and I found my passion. I finally knew what I wanted to be when I grew up. We set out to grow to 5,000 lots. We set a goal of 500 lots in 5 years, and we smashed that. We set out to be full-time in mobile home parks within 5 years, and we smashed that too. We pushed well beyond the limits of where we thought we could go, and we bootstrapped our entire portfolio. We had no money, no experience, no network. Outsourcing things, especially upfront, proved impossible since every extra dollar went to buying more deals or literally basic survival. Fun money? Forget about it. Title work? I got this. Database work? I guess I'm staying up late. Cold calling? You bet. Flash forward nearly 6 years later, and we have full-time employees, virtual assistants, and plenty of ways we can outsource activities to really grow our business. But now, we sit on the precipice of going corporate. This company we all bootstrapped together from nothing now faces a challenge no one told us to expect. We're too big. Chapter 1, the corporate threshold. I escaped corporate America because I hated useless meetings, soul-crushing work, depression culture, and generally speaking, feeling stuck. When I left, I swore to never go back. I set out to grow a company to allow others to escape too, either through this podcast, so you can learn a way out on your own, or to create a cool work environment for my employees so they don't have to suffer through what I did. I guess I didn't realize that eventually I'd reach a point where I ironically needed to get corporate like to grow. You see, we bootstrapped our company, meaning we threw together employees, systems, networks, and a portfolio all on a seriously lean budget ourselves. In time, we won't be able to do accounting in-house anymore. We'll need that outsourced. In time, we'll need an actual COO as my time is going to be stretched too thin. In time, we'll be forced to go beyond reasonable driving distance from our homes since the opportunities locally just won't exist anymore, or at least not in the way that we would want them to that matches our strategy. How do you resolve this? Well, you become that corporation that you tried to escape. I remember the first meeting I had with my friend Mike Conlin, who I interviewed on mobile home parks in real life back in January of 2019. During that first meeting, Mike told me he loved sitting at about 5,000 lots because any more would really become corporate land. What I didn't realize at the time was that Mike had a killer CEO in Chris, as well as a team of accountants, admin employees, and various other folks to handle work beyond simple property management. I did not realize the threshold for having to hire more than just property managers falls around, if not before, that 1K mark. And yes, that's even for a portfolio of stabilized properties. By the way, with our mentorship program, we have spoken to and even taken on consulting gigs with companies struggling with exactly what I'm describing here. You see, it's not just that mobile home parks are hard work. It's that they start to require human capital, AKA employees, much sooner than you think. And those employees need training, oversight, and of course, money. For those of you listening in, working a job that you hate, and you still haven't bought your first mobile home park yet, this episode may sound crazy to you. Like, why shouldn't I just hit the pause on acquisitions and just fix those liabilities and then just chill out with the income I'm making for the rest of my life? Chapter 2, the high cost of doing nothing. Tim Ferriss dedicates an entire portion of his book, The 4-Hour Workweek, to the pitfalls of joining the new rich. It turns out chilling for the rest of your life is actually pretty miserable. As humans, we long for meaning and purpose and some kind of meaningful work. We also gravitate towards novelty as we grow bored of monotony. Yes, believe it or not, becoming filthy rich can get pretty boring in time. Circling back to mobile home parks, let's look at Archimedes Group. Ian and I both escaped corporate America, and we did reasonably well financially, and we could probably just retire on what we have now, opting for a middle class to upper middle class lifestyle indefinitely. But I am someone that can't even take a 3-day weekend without getting bored. I couldn't even tell you the last time I took a vacation. I love what I do, and I love working. So naturally, I don't want to chill out. I want to work. And I want to help others too. So what did we do? Well, we bought more mobile home parks. And since Ian and I both love helping people, we took to that next level with our mentorship program too. Why do all of this when the goal originally revolves around not working unless we wanted to? Well, we discovered we wanted to. And now we sit at a place where we really can't walk away and do nothing without hiring several employees, which would seriously eat our cash flow. So we've reached a point where doing nothing itself comes with a high cost, not only psychologically, but also financially. Chapter 3, the next 1,000 lots. So while Ian and I bootstrapped our way to 1,000 with our own money and on our own terms, the next 1,000 lots will not look that way. We would not have the luxury of doing it the same way. We would need to bring on some serious outside capital. Could we get lucky like we did with our current money person? Sure. Perhaps we find another stud partner and continue to rock and roll, sans worry about investor calls, demands, deadlines, complaints, reports, etc. But most likely, whatever capital we take on will come with some investor relations that will start to feel more like a job than what we had before. So why not outsource that? That brings up the next point. Outsourcing. I handle all accounting in-house. Rent Manager automates most of my books, leaving me to reconcile the bank statements once a month. And we also write less than 20 checks a month. So most of our bills are set up on autopay, and it's pretty much set it and forget it. But that will eventually break down. You see, my time is not best spent as the accountant or the IT person or the accounts payable employee. I will have to outsource that admin work, which again will eat into our cash flow. So, with likely not the same investor situation, a need to hire more, and all in all, more work and less cash flow, I guess the next question is why? Do we want more capital to raise more capital? Do we want to have more meetings to check on employees, to worry about the machine we built continuing to operate? Isn't that exactly why we got out of corporate America? Sure, I am dictating and I am the boss how everything will go, but is that really what I'm truly after? Now, let's just hypothetically say the answer to all of that is yes, we do want that. Well, then comes the question of the market. Currently, we have scaled a portfolio of an average mobile home park size of about 40 lots in a very tight geographic footprint. That strategy will have to change. I will have to break into new markets, network hard locally, hire more property managers, understand local legislature, and generally speaking, do more of what we have already built over and over again in new markets, introducing a lot of more time and potential liability. And if we continue to push in primary markets only, then I will have to expand beyond where I can reasonably drive to in a day. Or I'll have to start buying in secondary or tertiary markets. No matter what pivot I make, this could seriously compromise the portfolio. If I have built a portfolio with a certain strategy and then pivot and start buying based off of a new strategy, I risk this portfolio not having a consistent rhythm to it, which could hinder large-scale sales or refinances. Again, the theme I keep coming back to here is there is a big difference between 1,000 lots and 2,000 lots, or at least there can be a very dramatic difference. Chapter 4. Okay, why not just stay put? Growing obviously will come with some issues, and I will make less money on a proportional basis. So you'll make more money, but it will kind of taper off on a percentage basis. So also, selling could literally take all of my cash flow, not to mention all of the taxes I'd have to pay. So then the question becomes, why not just stay put with what you have? You know, what's wrong with holding on to assets for 20 plus years? Mom and pops do it, right? In the long run, the following will require your capital input: infrastructure, homes, taxes, power poles, fences, signs, trees, roads, water lines, sewer lines, etc., etc., etc. Where will your capital come from? The simple answer is your cash flow. Whether you pay out of your distributions or you refinance your property to have the cash, no matter which way you cut it, for a time, you will have to reinvest in your property. And replacing a septic tank isn't a legitimate reason to raise rents. You're not adding value to the property from the tenant standpoint because this is expected of you as the owner of the land. So you don't necessarily get something for this in terms of cash flow. Have you ever had a tree take out of a home? We've had a tree destroy a home before. And guess how much it costs to replace that? It's debilitating. It's 30,000 plus. A lot of money, and you need that cash up front, and it's very hard to find someone to literally come in and give you $30,000 cash and then want to pay lot rent as well. It's hard to find. It's like a unicorn. Speaking of which, what about the homes? Well, eventually you will need to start replacing those homes. Each year, a home gets older. Duh. Well, eventually they're not going to be habitable anymore. Or at least they're going to be such eyesores for the property, if not just plain not worth investing in, period. As I've said before on other episodes, infilling homes can really become burdensome from a capital perspective. What about taxes? Well, eventually you won't be able to claim depreciation as a tax shield anymore, at least not the way you could immediately after purchasing. While that may be subject to change with new regulations, what can essentially be guaranteed is that your tax rate for this property will go up too. Seriously, name a business that exists in which capital doesn't need to be infused at some point to make a business continually viable. Unless you go down the road of slumlord, eventually your cash flow will start taking serious hits. And you won't have those same advantages decades down the road that you have right at purchase. This all leads back to Chapter 5, Liabilities. Beyond capital expenditures, we arrive back at what my wife and I were discussing on that lovely morning walk: liabilities, lawsuits, power-drunk bureaucrats, evictions, fires, falling trees, storms, insurance companies dropping coverage, outside crime creeping in, government regulation, and on and on. Lawsuits will happen, period. Sure, most will be threats or legal layups for you because lawsuits in general suck. Win or lose, lawsuits will wear you down. Even the totally frivolous ones. Power-drunk bureaucrats, unfortunately, exist everywhere. By the way, you think you get angry at ignorant political Facebook posts, you then go try listening to clearly ego-driven, baseless, power stick whacks from a local know-it-all who has way too much authority. We run a collections business. That's what mobile home parks and this type of real estate is. You can only make as much as you can collect. So no matter how well you actually operate your business, you're going to have evictions. And evictions just get tougher when someone owns their own home. I have talked about this on several prior episodes. Acts of God, fires, trees falling, storms will stress you out. Whenever the local weather warning pops up on the TV screen, I immediately text all of our local employees and keep an eye out for texts and calls on our mutual Grasshopper phone number. These acts of God do occur and can cause some serious damage. And let me tell you, if your goal is to hold for decades, it is literally just a matter of time as you hold your parks in perpetuity. Insurance companies tend to get in and out of this space with little to no warning. And this can be as annoying as it sounds. Back to that power drunk bureaucrat I was mentioning earlier, insurance companies can sometimes have overwhelmingly nitpicky inspectors. Outsiders inevitably will pay unwanted visits. In the last 5 years, we have had 2 shootings at our properties. Both involved outsiders. Unless you want to put up a gate and literally screen each incoming and outgoing person, you will always have unwanted guests disturbing the peace at your community. And worse, one could make a case against you for negligence. Again, even if it's a completely frivolous case, it's going to wear on you financially and psychologically, win or lose. And finally, as we saw in New York State, the government imposed rent locks preventing property owners from raising rents beyond a certain point. This severely impacted property values and profitability, and that, while that may or may not happen where you do business, the mere threat could present a serious liability for folks looking to be long-term holders. Chapter 6. But you can't sell. While liabilities, capital costs, and calls, and stress to grow occur in scale as you grow your portfolio, in theory, yes, so does your cash flow and net worth. So selling would eliminate that cash flow and have a potentially gigantic tax event, just taking a chunk out of your net worth. But there's something just so final about having cash. Cold, hard cash sitting in the bank comes with effectively no liabilities, no outside stresses. Barring some calamity, your risk exposure sits dramatically lower than owning an asset. Also, if your goal was always to escape a corporate job, in theory, having enough cold hard cash would allow you to just retire early, right? The question then becomes, at what point in time does the post-tax proceed outweigh the long-term cash flow? While that's a very deeply personal question that only you can answer for yourself, I'll say for me, most folks that I have discussed this with say about 10 years of cash flow today means sell. And that's 10 years of cash flow post-taxes. So if you expect to make $100,000 per year for the next 10 years, you would need $1 million post-tax to consider a sale. Does that get a guttural reaction out of you? Why sell $100,000 per year investment? The answer? Because you have $1 million. While you may have needed, really, you need to think about it like this. While you may have needed to invest in something riskier to hit that $100,000 mark, you may be able to take that $1 million and invest it in something less risky. So for example, if you were making a 20% return and had $500,000 invested in said investment, but now you have $1 million and you can put it somewhere that's going to get you a 10, that's still that same $100,000. And the difference between, in theory, academically speaking, between something that's going to give you a 20% return and a 10% return, all things being equal, the 20% return is going to come with more risk than the 10% return. So in theory, you could actually be trading the exact same cash flow for less risk and liability. Not to mention, if you're like me, I sign Recourse for every single deal I do. So in other words, just getting rid of switching from a general partner to a limited partner, getting rid of things like recourse debt and keeping that same cash flow, that would smash the idea of being a long-term holder of something, because you're effectively getting the same thing for less risk. That's a no-brainer in most cases. This process I'm describing here is what's called recycling capital. When you successfully invest, create equity, you either need to refinance or sell so you can then take that created equity and put it to a higher and better use. However, the devil's advocate play to this is, where do you find a vessel that can give you that type of cash flow? Shouldn't that come with the risk of also not being able to properly place that $1 million and get those returns? And this brings up my next point. Highest and best use. Are you actually the highest and best use owner and capital for your mobile home park? Chapter 7, the life cycle of a mobile home park. So the story goes that mom and pops don't manage well and sport below market rents. So if you buy the property, fix the inefficiencies, and raise the rents to market, you profit. But the story doesn't end there. If you then sit on that property for 30 years, you too one day will become the mom and pop. So what does that mean? Who should this final end user of the property be? Or at least, who is next in this chain link of owners? So again, if we come in and we make the property more efficient and raise rents to whatever market is, then in theory, we will have achieved a market enforced rental increase barrier. In other words, you will have people who are not willing to pay you anymore unless you upgrade the property. So in other words, this free market capitalism type self-imposed market enforced barrier to raise rents, how do you break through that? Money. Lots of money. You're going to need to bring in amenities, pools, trim trees, new homes, new sign. You're going to need to dump in capital so people feel like they're getting something for their dollar. So again, let's say the free market tells you the maximum lot rent for your property is, say, $500. So how do you get to $600 lot rent? Again, you'll need those amenities that I mentioned, or new homes, or just some value above and beyond what your property currently provides. So while we come in buying properties from mom and pops to bring lot rents from, say, 300 to the market of 500, then who is that capital that will take the lot rent from 500 to 600? And the answer is a private equity shop or some large-scale syndicator. It's going to be an individual or group that's cool with, say, a 10% cash-on-cash return. While we get pumped up about capital multiplication, those types will get pumped up about capital preservation. So if you're like us and you have no choice but to multiply your capital because you started with nothing, then owning an asset once it hits true market rent may actually not be the highest and best use for both your capital and that property. It may be time for you to sell to someone else whose capital goals dictate a completely different strategy. If you've ever seen the Batman movie called The Dark Knight, there was a wonderful line that went something along the lines of, you either die a hero or live long enough to become the villain. Eventually, if you don't sell, you become that mom and pop. Chapter 8, Recapitalization. Eventually, your capital and strategy, like I said, may not be the most appropriate fit for that property that you own. But does that mean the best course of action is to just sell? Not necessarily. If your property requires an influx of capital to achieve highest and best use, you can recapitalize. A recapitalization can be used to replace old capital partners and structures with new. This new capital can be open to just an 8% return or only a 5-year maturity or so on and so on. For the example I mentioned earlier about replacing $100,000 of annual income with $1 million to place in a less risky investment vessel, well, a recap can provide you with exactly that. And a property that you know very well lacks serious landmines, and can actually serve as a less risky investment vessel for you, well, you could possibly take cash out, freeing up some equity, as well as replace your recourse debt with non-recourse debt. And long story short, you could actually restructure the whole thing to free up some of your money, put better debt on it, bring in new partners, influx it with capital to raise rents a little bit. Long story short, you can actually change everything that's going on and be that next chain in the link of a more capital preservation play than capital multiplication play. Regardless of which way you cut it, a recapitalization event can serve as a way to recycle your own capital and bring on more appropriate capital to get to that next level, or at least convert your capital or some of it to more of a preservation play. However, this too will come with some potentially serious consequences, some of which I laid out earlier. Chapter 9, the life cycle of a business. My MBA venture capital class imprinted an indelible lesson in my psyche. That lesson: no business lasts forever. Every business dies. Even the big ones, like Sears. Even centuries-old businesses die. The 5 stages of the life cycle of a business include the launch, growth, shakeout, maturity, and decline stages. Mobile home parks, in my opinion, sit comfortably at the maturity stage. What does this mean? Eventually, we will die slowly on that decline path. Wouldn't you want to exit before that? My venture capital class littered me with example after example of serial entrepreneurs that launched, grew, and eventually sold out of their companies before ever having to worry about maturity or decline stages. In other words, they rode the wave until the optimal time to sell. So for their respective businesses, they bought up the mom and pops or straight started a business from scratch, and they brought their lot rents to market, influxed that capital. And then when it became clear that the massive capital influx would be the only way to get to that next level, instead of recapping, they simply exited. In short, these hyper successful serial entrepreneurs, they would take a company from launch to close to maturity or in maturity, and then sell out for a serious capital multiplication event. They ride this wave of a company until its value either comes close to plateau or again starts to decline. They are not lifetime holders, and they acknowledge this going in. At some point in time, you will have to relinquish your ownership of your mobile home park. The true entrepreneur, guru type investor, will time this exit at its most lucrative point. And I don't just mean the amount of cash. That also can mean a jump from one potentially demoralizing and unhappy path to the next stage in life that's exciting and fulfilling. So, does all of this mean that I'm recommending you sell at 1,000 lots, or that Ian and I are done with mobile home parks? Absolutely not. This just means that hitting 1,000 lots gives you serious options. As for Ian and I, we could stay put, we could sell out, we could recapitalize, or we could just grow to double what we have and beyond. At 1,000 lots, Ian and I simply sit at a wonderful stage with options. At this crossroads, we must either graduate on, promoting ourselves to that next level, or selling out and moving on to whatever the next part of our journey is, or find a way to come to peace with where we're at, what we have, and, stop growing altogether. Regardless of what we choose, this should be about what you choose. What do you want? Do you want to chill out with cold hard cash? Do you want to sit still with the cash flow that you've got? Or do you want to grow to double your size and create a corporation that you may have been trying to escape to begin with? 6 years ago, no one told me what this was going to be like. And at the time, basically, no one would talk to me anyways. Today, as I go through this stage lifetime and can better plan for and think through how I'm going to grow my business, you too can share in what I am experiencing to better make decisions and plan for what you want to go through. And let me tell you, this long journey provided plenty of soul searching moments where I learned to love things that I thought I hated, like accounting. And I came to hate things I thought I would really enjoy, like legal issues. And your partners, they're going to change too. If you asked Ian, I bet he too would say that he grew to love some things and absolutely hate others. And I'm sure that process does not stop after hitting 1,000 lots either. I'm sure if we grew to another 1,000, there would be a whole host of things that we would encounter that I didn't really even anticipate that I would absolutely hate everything about. And there are other things that I don't like now that I may come to embrace in time. So, how do you plan for all of this? Well, having been there, I will say that you really can't. You really just need to start thinking about this stuff now. And don't assume things. And at the minimum, don't then think about the opposite of those things that you have assumed. You need to be thinking from all angles and challenging all of your assumptions and trying to uproot convictions. And even if you had all of that planned out, if you are partnering with folks, you just need to realize that they're also going to go through that too. One day they may want out, or one day they may want to continue to grow and you want to chill out. And that's going to cause some serious friction. But above all, I didn't have anyone really to talk to about this about 6 years ago when I started out. Not that I would have changed anything about how I would have done anything. I probably would have maybe anticipated certain things a little bit better, but I will offer anybody listening to this, quite simply, you can reach out to me. I mean that. Again, 6 years ago, I struggled to get anybody to call me back. Now, I had nothing to offer, and the market reminded me of that constantly. Now, while I come from sales and I was pretty much expecting that to be the case, you don't have to suffer that like I did. You can reach out to me. Throughout this process that I've been going through for 6 years, one thing that I realized was really important to me and really made me happy is helping people. And that's why we've beefed up our mentorship program, is because I want to help people like you listening in. I don't care if you have 10,000 lots, no lots, or anything in between. I genuinely speaking love helping others. And I genuinely speaking want what's best for this space. And I want you to find happiness. I want you to win. I want to help you see the world from a vantage point of reality and not hype. And most of all, I want you to go out and be a beacon of good for the mobile home park space, finding ways to help others and improving the reputation of mobile home parks. And you can do all of this by thinking through each step of your journey, reverse engineering it from reality, not hype. And people like me are here to help you just for free along the way. All you have to do is reach out. Now, I really hope that this episode helps display in a way how your strategy will flip on its head more than once, and then we'll do it again and again and again over time, making change be a constant. So after all of this, to digest all of what I've discussed today, all those years of worrying and battles fought and properties stabilized and employees hired and fired and all of that, what is my best advice about hitting or at least striving for 1,000 lots? Make sure you love it.